Good afternoon, everyone. Today is July 1st, 2022, and it's Canada Day today. So, yeah, be proud to be Canadian if you're Canadian. And if not, Americans, you get your holiday in about 3 days. So, celebrate living in a great place in an interesting time. Today, we are going to be talking about what has been going on with the economy, a little bit of a recap as to where we might be heading over the next few months, looking at things like GDP, what is the Fed going to do with rate hikes, what are some of the crazy things the Fed has actually said in the last week. And then we're also going to dive into the whole crypto contagion. We did this special about 2 weeks ago talking about Celsius, Three Arrows Capital, and I believe Luna. And there's a whole bunch more bloodshed on the way. The price of Bitcoin's been quashed, but maybe there's light at the end of the tunnel, and we'll dive into a little bit in this week's show. Before we dive into it really quick, just a reminder that I am putting out videos now every Monday and Thursday. They are just YouTube stories, but they're fun little snippets, lots of good trivia in there, so be sure to check those out because YouTube will not send notifications on them no matter what I do. But they are on the channel, and I'm also on TikTok and Instagram under the same channel name. All right, let's dive into it. So the first thing we want to talk about when we're looking at the markets and the economy and all that is where is GDP going? Because when we look at what the Fed is doing, and we might argue that the Fed kind of controls the markets and the outcome of the markets, they have their two metrics, which is unemployment and inflation. And so right now they're battling inflation, but at another point down the line, they might be battling unemployment because it looks like we are likely going to be heading into an official recession pretty soon. And yeah, let's dive into why I think so and why a lot of people think so. Probably you too. All right. So the Atlanta Fed has a forecast for GDP growth, and we had that estimate in Q1 of this year, which was, I think, January to March, which was saying, look, the U.S. economy is slowing down, I think, by negative 1.5%. And so technically, if there's two consecutive quarters of declining or negative GDP growth, that qualifies as a recession. Now, that's not news to everyone, but it is news to a lot of everyday people who don't pay attention to financial news media. And so I think it's going to be really important to look at the time that this official Q2 GDP estimate comes out, and that is going to be July 28th. I believe that's going to be the day that every single news station picks up this idea that we are in a recession now. And I think it's really important because so many people in the Biden administration and up here in Canada have kind of been denying that we are in any sort of recession. They've been acknowledging, obviously, high gas prices, the war in Ukraine, stuff like that, but they've been putting out a lot of numbers saying the economy is doing fine and whatnot. I think by July 28th, everyone's going to jump on board because the official metric for a recession will have been met, which is 2 quarters of consecutive negative GDP growth. So, does that mean buy the news? I don't know. But it's interesting because the Fed did previously have a positive estimate for Q2 GDP growth, actually all throughout May and June, and just very recently they adapted it downwards quite heavily to negative 2.1%. Real growth, and that is factoring in inflation and what the economy is actually cranking out. Another thing to look at is in the whole basket of what people measure inflation and CPI with is housing. And so we know that housing has actually been probably one of the most resilient markets, but it's also one of the most illiquid markets. So stocks have gotten hit. Now it looks like most commodities are rolling over with the exception of oil. And obviously cryptocurrencies, but everyone's wondering, like, when is the housing market going to collapse? That's the one that everyone's praying for actually collapses so they can have affordable housing. And I'm not going to go into, U.S. housing data or all of Canada housing data, but particularly for me in Vancouver, which is one of the most speculation-heavy housing markets, Steve Staretsky has posted some interesting stats, and one of them is that Greater Vancouver home sales recorded their second weakest month in June in over 20 years. A lot higher mortgage rates are also on the way, obviously, and that's slowing buyers down. But just because mortgage rates are going higher, just because sales are going down, doesn't mean that prices are quite going down yet as well. So home sales in the suburbs took the brunt of this, down about 47% year over year. We know that obviously, people moving out to the suburbs kind of peaked during the pandemic as everyone wanted to get out of the city. But 47% year over year slowing of growth is pretty big. And And then he ends here, just so we're clear, higher mortgage rates does not mean a flood of panicked new listings. In fact, listings are down from last year. Inventory that's being listed is sitting longer and accumulating over time. And then some other stats here. These are declines from peaks in my area. So if you're from Vancouver, you'll know what I'm talking about. If you're not, you won't. But basically, these are suburbs and urban places in Vancouver. Average median price declines from the peak of housing to June, negative 16% for Fraser Valley, Greater Vancouver, negative 10%, Surrey and Delta, negative 17%, etc. So there are declines happening in the housing market, but again, this is from an incredibly inflated market. I think beyond still the prices maybe coming down a little bit, more inventory coming online, I would say the housing market still hasn't really crashed per se. And again, one of the things that I talk about, which is why I believe that the housing market is not going to see the same type of collapse as obviously crypto, but the stock market and bonds as well, is because you can do something with the asset. You can be stubborn with your asset. And because most people are purchasing them with either all cash deals and they're not looking to flip them necessarily tomorrow, or they are in fixed mortgages. And so it's going to take longer periods of declines, I think, for the housing market to go belly up. And just remember, it's not going to happen like 2008 if it does. The governments know how to backstop this stuff. All the new money that's printed, a lot of it came from the buying of mortgage-backed securities. So you can bet your butt that they are not going to let the housing market collapse. They'll let the stock market collapse. They'll let parts of the bond market collapse, but they will step in if housing shows any type of collapse. And of course, when I say they, I'm talking about the Federal Reserve and governments. They will just make sure that home buyers are not left out in the cold. All right. Let's talk about this title of the whole live stream here, which is a bifurcated economy, because I think the recession that we are potentially going into is not going to look like recessions of the past. And recessions of the past are everyone kind of loses their jobs, maybe some faster than others, and prices of things go down as well as consumption goes down. I don't think it's going to look like that. I also don't know if stagflation is the right term to use. So the term I've kind of gone with, and Marin Katusa, who Bennett turned me on to, a really great economist and writer, has a great book I'm going through, coined this phrase crossflation, where basically you can have extreme inflation in certain areas of the economy while other areas are going down, and that leads to kind of like misallocations depending on how much money you're spending on certain things. The one that I've mentioned in the past is I really think that discretionary items, we're talking TVs, furniture, all the things that you want but you don't need, not essentials, not consumable goods, these things are going to drop dramatically in price because there is this thing now, and even Michael Burry agrees with me on this, called a bullwhip effect, which is essentially going into the height of the pandemic, we had all this demand for all these new products. Everybody wanted a new jet ski, new patio furniture, whatever, right, with their new houses or whatnot, new TV, let's say. All this demand comes in, and basically supply chains are kind of lagging, so it takes them a little bit of a time to crank out output and to meet the demand of everyone, right? And you've experienced this too. You've gone to stores probably and you've seen certain things not there, and you've had to wait on back orders to get things. All that supply chain is going to unclog eventually. Now, it stayed clogged a lot longer than most economists have predicted, but goods are still going to get made. These orders are not going to get canceled. And eventually, and I think actually already we're seeing flooding of goods into stores like Walmart and Target and all these places, all these things that people wanted to and posted kind of sustained demand for, that now with this recession coming, with everyone's portfolios getting nagged, with a whole bunch of people losing their jobs who are working at tech companies, that demand's going to evaporate, but all this inventory is going to be here. And essentially what I think that's going to lead to is retailers taking drastic action, sending these things to liquidators because they're taking up too much space in the store. And this headline came out that retailers are weighing the cost of paying customers to keep unwanted items. So we're going to get to a point, I think, eventually, and they've already talked about this, where you order something, let's just say it's a table, and you're unsatisfied with that. They'll tell you, forget it, don't return it, just keep it, just send us some photos maybe to prove that you're unhappy with it or something's wrong with it, but just keep it because we don't want to deal with it. And in fact, there's this idea that they might even pay you to keep the item as well or charge you to return it, which is already done. But yeah, Target, Walmart, Gap, American Eagle, and other major retailers possess too much inventory. Now, I don't think that's going to be the same thing with food. Food is, produces a much higher frequency than retail goods and discretionary goods. So they can adapt to supply and demand, I think, pretty quickly. But I think it's definitely going to happen to these discretionary products that, again, we don't really need, right? We also know that, again, CPI is not, it's the non-metric metric. I was reading the other day that when the Bureau of Labor Statistics, which is the organization in the US that calculates the CPI, when they go out, it's like 400 people, and they go out to different grocery stores and they take pictures of prices of things like applesauce or milk or eggs or whatever, right? So sometimes when this data comes in, usually by the time you get an updated CPI number, it's totally lagging. So from one month to another, we're not getting the greatest data, but I think you're going to see these radical declines in these discretionary purchases probably in the next few reports of CPI, and I think that is going to bring down inflation. The question is will it balance out the inflation in other items potentially? I don't know why my videos are auto-playing, but they are. Because we know that obviously like oil is a big factor as to why CPI has been rising so quickly lately. And it could be that, the discretionary goods coming down will bring down CPI. Maybe food prices will go down as well, but will oil keep everything up? Will housing keep everything up? I don't know. I would say it looks like most things in the CPI, and housing is 42% of it. Those things are going to get hit, I think, as job losses kind of creep in and, median wages start declining as well. Let's talk about the other thing, as we mentioned, oil. Now, I'm not an expert in oil, but just some interesting things here I'd love to share. There was a clip of the French President Macron with Biden at some summit, and there was some audio actually taken from like a conversation they had while they were walking, saying that Saudi Arabia and the United Arab Emirates can't really increase their oil production that much, right? And so much oil comes obviously from the Middle East, but they're already saying, look, we can't rely on them. So again, it's just a sign that oil could possibly be going a lot higher from here. And this clip too, which I just find outrageous here. Try and crank the volume up on this. A Biden advisor was asked about what do you have to say to the families that can't afford gas? And this is kind of what he said here.
Sustainable. What do you say to those families who say, listen, we can't afford to pay $4.85 a gallon for months, if not years. This is just not sustainable.
Well, what you heard from the president today was a clear articulation of the stakes. This is about the future of the liberal world order, and we have to stand firm.
Sustainable. What do you say to those families?
Yeah. Future of the liberal world order, and we have to stand firm. In short, suck it up. We need to keep fighting this war in Ukraine. Gas prices are just the cost that you're going to have to pay. I think that's a terrible tactic for an election, because I think the popularity of keeping this forever war going on with Ukraine, and again, it's like it was either going to end in 2 weeks when it started, or it was going to go on very, very long, and it's going on very, very long, and it's not going to end anytime soon. It's just costing Americans, not only at the pump for the increased price of gas, but it's also costing them, so much in tax dollars, all the weapons and stuff that we're sending over. I mean, the military-industrial complex loves what's going on, but I don't know. Not that popular as an election stance, I would say. And then if we're going to dive into like technical analysis on all of this stuff, this is the chart for light crude oil futures. And basically, we're kind of range bound here between the recent high of 130.50. That was kind of the blow off top right after the week of the war starting. And then the consolidation low a couple weeks after in April of 92.93. So we're right at 108. So what I would say is you don't have to be a master charter to kind of see what's going on here. One of these levels is going to break in the next few months. And I would say if the level breaks to the downside here, 92.93, I think that would really boost inflation coming down. So that's a really interesting number to watch. 92.93 on oil, and you'd want to obviously see like a close under it, not just like a little tiny break and then we go back up. But that would indicate, I believe, monthly consolidation on oil. and month-over-month consolidation on oil. Again, there's exogenous factors here, but it would likely lead to a drastic lowering of inflation, kind of across the board for all sorts of countries. Probably a good thing for humanity. If we break it to the upside, there's really only one resistance left on oil, and that's 147, which is the all-time high that we hit in 2008, last global financial crisis. But it's so interesting, like these things can really, again, it's this term bullwhip, right? Like the last time we hit all-time high on oil, within a couple months, it dropped like 80% and it went to the lowest prices in like 4, 5, 6 years. So yeah, I mean, it's a pretty manipulated market, but those are the two levels I watch for to kind of tell me, and I think it's going to dictate Fed policy for sure where the price of oil goes. But yeah, anyways, those are levels. Another article here as we dive more into what is going on with this bifurcated economy. This is Michael Burry, and he says, I see a bifurcated labor market developing as unskilled and semi-skilled remain in short supply, but white-collar workers, having proven their redundancy during COVID, will find gross excess in the labor market, pressuring wages at the end. You probably understand what that means, but the layman's term is that there is still a huge demand for, blue collar jobs, whether it be in things like construction, whether it be in, entertainment and leisure services and stuff. But on the high end, a lot of companies have overhired, people in marketing, people in coding and things like that. And you're seeing all these companies. Tesla is laying off staff. The layoffs are concentrated in these really high-paying jobs. And so what that's going to cause is actually really big median wage deflation. As people who are making, money in skilled environments are losing their jobs, and as people are, either those people are taking on blue-collar jobs or, blue-collar jobs are making up a bigger part of the workforce, you're going to see median wages really decline as well. And again, all signs point to recession and deflation at the end of this. So, there's only so many things that the price of oil can dictate. If the entire market is weak, if consumers are out of money, prices will naturally fall. They cannot go up forever if the consumer is not there. If there's no demand, there's excess, and if there's excess, it turns around the other way. And then, just to show, like, this is a chart of some of the most in-demand jobs and job vacancies right now. We've heard a lot about how, there's all these job openings. There's 2 job openings for every job. These are some of the jobs, right? Food counter attendants, kitchen helpers, average wage offered $14.90, 119% increase in job vacancies. Food and beverage persons, retail salespersons, registered nurses. If you just look at the wages here, like these are pretty low wage jobs, and these are all the ones that are opening up for people. And they don't take a ton of expertise. So again, fancy degree that you got, you might be the first to be laid off. You're disposable no matter how many fancy degrees you have. But we need people in the real, day-to-day economy. So interesting to think about. I'm curious how people feel currently if you have a job where you are. I have an interesting conundrum because I think about, my actual business where I make my money, which is through my video production business. And I feel like that did really well during the pandemic because everyone got into, multimedia marketing and stuff, and everybody wanted videos for Amazon products. And I did pretty well. But I think as we go into this declining consumer demand, it's probably going to come at the cost of lowered marketing expenses, right? So I'm selling, probably what would be considered pretty premium marketing services. So, my business is going to take a hit. But for the most part, it is just me doing it. So it's not, I don't have any employees to lay off. Let's just say I hire almost exclusively contractors, so I'll be fine. But I'm curious if you're running a business yourself or you work at a company, if you're starting to see shifts in consumer habits, if you're seeing more traffic, if you're seeing less traffic, what are your concerns about, what is going on? And, that's in addition to what's going on with the market, but just in your job or your business, are you starting to see a turning of the tides with this recession and the data that is starting to emerge that would back up the likelihood of a recession? Lastly, let's talk about central bankers, everyone's favorite subject here. So Jerome Powell on an ECB forum on inflation said, "We understand better how little we understand about inflation." So he came out and he was saying, there's all these things that happen that we didn't predict and we kind of got it wrong. And it's just like, well, a little humility never hurts, but also you are in charge essentially of the entire global economy. The fact that we have these leaders coming out saying they don't really know what's going on and what to do, and all they're doing is just using their blunt hammers to try and fix things, like skyrocket the interest rates or bring them down. It's like we got a drunk driver or a clown at the wheel here. And Greg Foss made an excellent quote when I was listening to him live, and he said that in terms of like trying to predict where the bottom is going to be, because everyone's been talking about, oh, wait till the Fed pivots, then buy everything, or try and buy before the Fed pivots so you can buy stuff cheap. His quote was, if you try and front run a clown car, you're going to end up in the three-ring circus. And essentially, this is what's been going on with central banking. We got clowns at the wheel here who are admitting that they don't know what they're doing. And, they were late to inflation. So the likelihood that they're going to execute a soft landing for any organization would be low. But for the people that are currently in charge, it's extremely low. In fact, I would say almost statistically impossible. Because I think we're already entering a recession. So I think the soft landing is out of the question already. I think a lot of people are already hurting, and it's only going to get worse. So how's that for a positive Canada Day message? But yeah, and this essentially all stems from one idea. When you really break down what has been going on with inflation and everything over the last 50 years, it comes from one basic Keynesian economic principle, which is that if you don't have inflation in the economy, no one is going to go out and buy anything. And so central banks have been trying to architect an ideal level of inflation, right? They have been saying, our mandate is 2%, and then they've changed that to 3 or 4. And I think by the end of this whole cycle, they might say acceptable inflation is probably a little bit higher. Maybe it's like 4%. Maybe we can't get back to our 2%, right? This idea that there's an ideal inflation number, I think it's just bogus, because we just know naturally technology always makes things cheaper. This is the essence of Jeff Booth's book, The Price of Tomorrow, and that's essentially the only place where you can see this in action is in tech products, right? Humans gravitate towards technology that makes everyday living expenses cheaper. We get more for less all the time. When we're talking about, how powerful our phones are, memory cards, laptops, we're getting more for less every single day. But when it comes to all this other stuff, it's really hard to tell because central banks are injecting all this money. And so we don't get that conception of more for less because the money supply keeps growing, right? So at a base level, if we didn't have inflation, we had a fixed money supply, everything would likely go down in price over time, right? Because we're able to make everything cheaper. Only scarce goods that have a fixed supply along with the money supply would hold their value or maybe go up in value as they became scarcer and scarcer or more desirable. And again, I'm not talking about short-term fluctuations. I'm talking about long, prolonged periods of time. A good chart to kind of look at this is essentially economists, before we had a fiat dollar in the US, when it was on the gold standard or before we officially declared fiat, the cost of electricity had gone down for 60 plus years, right? Why is that? Because we found much better forms to make electricity. Hydroelectric was invented. We found cheaper and cheaper ways to extract oil and other fuels to run things. And we continue to find cheaper and cheaper ways to create electricity, like every day, solar, wind, all these things. Yet, despite all this innovation and the ability for us to create more and more electricity, the price of it keeps rising, right? And it's obvious here where it happened. It happened right when the central bank decided to unpeg the dollar from the gold standard, right? 50 years plus, you can go back looking at like how cheap energy was, and then now we just get record increasing energy costs. And you know what? It doesn't get helped anymore by these ESG policies too, where they're saying you can't drill here, you can't do this. We want only solar, and we want only wind, and all this needs to be powered by lithium, which we can't mine within our country. So we need to have excess freighters delivering lithium from South American and African countries where their working people have to death. But it's all in the nature of saving the planet, right? Save the planet at the expense of human lives that are just getting desecrated. People who are barely getting paid pennies on the dollar to do the type of work we can, so that you can have your lithium batteries, your phone batteries, your Teslas, all this nonsense, while we have abundant energy supplies that, yes, emit CO2, but not at the cost directly of human lives and enslavement in other countries. It pisses me off. I won't go into it any further. But look, the reason that we have a diverse planet is to suit our needs in different ways. There's a whole bunch of geothermal up north in Iceland, and there's a lot of oil, and there's geothermal along the equator as well. There's all-day sun. This idea that we're just going to cover the earth, ubiquitously in solar panels and expect the same outcomes in every country is ridiculous, right? That we're going to use the same type of green energy everywhere. You want to have hydroelectric in deserts, right? Or you want to have we have such weird climates here in Canada. We'll have deserts that see an abundance of cloud and rain, and so what do you use to power them? Right? You can't run a dam. Maybe you can run wind turbines. Solar is not going to work that well because we have, changing time zones, and we have pretty dark winters and stuff. But guess what? All these deserts have a ton of oil underneath them, right? But we're not going to mine that because it's bad for the environment. It's nuts. Anyways, in my opinion, overall, the Federal Reserve, along with governments, don't know what they're doing, and they're going to keep raising rates at the Federal Reserve until something breaks. I think we've seen tech take the brunt of it first. Obviously, cryptocurrency. There's contagion in cryptocurrency, which is now escalating it even further. And I think, again, if consumer demand really starts to decline, it's going to take a couple quarters for them to factor in that data. In my opinion, I think that rates will stop being risen by the end of this year. I really think so. And if anyone wants to take the counter bet with me, let's do that. So if you think that rates are going to keep rising through 2023, I will take a bet with you on that. We'll come up with some amount of money that's reasonable. But I really don't think that they're going to rise past 2023 or into 2023. And again, another cool stat. Look at this. It took 215 years for total U.S. debt to reach $7 trillion. And we just added $7 trillion in the last 2 years. So look at that, the expansion of debt, expansion of the money supply. Also, WTF happened in 1971 is a great website that shows you the change in a bunch of demographic and monetary statistics ever since the government took us off the gold standard. I've quoted that one before. Another thing that I think is going to happen is it's really important that we watch how the Fed raises rates, and they're going to have to realize the consequences of their actions in other countries as well. Credit default swaps, which are essentially insurance on bonds failing, it's what Michael Burry purchased to make money in the housing market. Essentially, it's like a put on the housing market. They just surged to all-time highs. Last time, 2008, 2015. As rates start rising and the cost of capital is extremely expensive, right? And the IMF, who's providing capital to a lot of these countries, the cost to finance that capital goes up. You're going to see the price of bonds collapse. You're going to see yields jerk way higher, and essentially these countries are just going to default on their debt. And so there's not enough money in the world if you are quantitative tightening to bail out these countries, which will need bailing out, or else they're going to be on the brink of mass, internal damage, through societal protests, people losing their jobs and whatnot. So again, we have this credit-based economy, and the only way to get consumers to spend more is to give them more credit. We don't have a system where wages are naturally rising because the monetary supply is rising and it's jerking up the price of assets before it jerks up the wages. Ronald Reagan was famous for talking about the trickle-down effect, and it was that, all the economic goods would trickle down through the rich into the poor and all that. And there is a trickle-down effect, whether you believe in his version of it or not. But the trickle-down effect that we have is the Cantillon effect, where essentially as new money gets injected into the system, the most desirable and the hardest assets get it first, right? And then it trickles down into goods. And then you have this crazy inflation that we're having now. And then eventually wages will go up to compensate for it. But they are last on the spectrum. What the average person makes is last on the spectrum of the trickle down theory. So by the time it trickles down to you, you're getting little droplets instead of a bottle. But yeah, it's not good if sovereign bonds fail. Again, the IMF is funding many of these countries. You can't tighten credit into a recession because these countries are going to collapse and more money than ever is going to be needed. Every single time Argentina has been bailed out, it's been more money that's come towards them. And with them needing more money gives the IMF more power to do whatever. But eventually, I don't even think the IMF is going to have enough money to bail out all the economies, one of them being Sri Lanka, which just failed as well. And another stat here, I'm trying to find where it is. So we talked about before how, there's two elements that the Fed is using right now to prop up the economy and to, reduce their balance sheet. During the pandemic, they lowered rates and they bought a bunch of bonds, and that's how they created or printed new money. And so right now they're doing the opposite. They're raising rates and they are trying to sell off their bonds into a pretty illiquid market, which is likely why you're seeing credit default swaps go up. And essentially, they are bluffing because they set out a course which they said we're going to reduce the balance sheet by X amount starting in June. And so you can just see from the stats, the Fed reduced their asset portfolio by 21 billion this week, far short of the 67 billion they needed to reach their goal of 47 billion in monthly reduction. So instead of $47 billion in monthly reduction of the balance sheet, they reduced it by 1.5 billion for the month of June. So quantitative tightening so far has been a bluff as well. And again, all this leads to this whip that we're eventually going to have as we go into a recession. And again, this is going to take time. You're not going to see your pivot immediately. As it becomes nail in your head obvious that the economy is going into recession and we start seeing collapses and stuff like that, that's when the Fed will pivot. So it's not going to happen. They're not going to front run this stuff. I really don't think they have the foresight because they haven't been able to execute almost any of their plans successfully in the last 2 years. But they're going to have to start buying assets all over again, especially as the economy weakens. All right, moving on. Let's talk about Bitcoin and crypto and what's been going on there. There has been a lot of contagion going on, and actually 30 minutes before this stream just broke out, 30 minutes before the stream started, a story just broke out that Voyager is now suspending all withdrawals. So again, another one of these companies tied to Three Arrows Capital, similar to BlockFi, that is now essentially going under because they have a big default on their hands. And I just want to say, anybody working at Voyager or any executive watching this, probably no one, I don't know how you manage to lend 70% of your assets under management as a public company to a Singapore-based private hedge fund in the hopes that they would just give you like 10 or 12%. Statistically, I think it was something like Three Arrows Capital was guaranteeing, I think, 15 to 20% yield on stable coins and other things like this to private companies. And a whole bunch of private companies lent them money for this, or they borrowed money, giving them this promise. And so if you actually look at bond yields, it's like only 0.1% of bonds yield anywhere close to that. So if you knew anything about bond math, or if you knew anything about financial markets, you would know that like this idea that some random crypto hedge fund is going to be able to generate that yield is just insane. There's just no way. The only way you get yields that big is if there's solvency issues, right? And this is something to really remember, is like the higher the amount of yield that you're getting for anything, the higher amount of risk there is. It's just so important if you're getting into like financial markets for the first time to understand that. The safest, they call it, what's the term? The risk-free rate. The risk-free rate is like the 10-year U.S. Treasury bond. And so you buy a bond from the government, they'll give you like for a while it was like 1%, 1.5%. And you know this, if you go to your bank, they give you like 0.6% or whatever. Why is that? Because that the people that they're lending your money to are such highly esteemed creditors or debitors that they're going to make sure that your yield gets paid out, right? As you go further in the spectrum, let's just say you start lending money to corporations and maybe, crappy penny stocks or corporations not managed well. These companies, in order to get any money because of how poorly they've managed things in the past, they have to offer yields of like 5 to 8 to 9%, right? And they're considered very risky. And so when people are putting together portfolios in which they want to get dividends or they want to get bond yields, they only put a little bit of these ones with really high yields in because the odds of you losing 100% of your principal can be pretty high. And so the fact that a company like Voyager Digital, which has a CFO on the board and all these people, I think the CEO of the company was involved with E-Trade, got this message from Three Arrows Capital that was saying, look, we can give you 15% yield and then you can give your customers 7 or 8% or whatever. They didn't do proper risk analysis on that. It's just bonkers to me. It really is. Now, I'm not saying that all yield companies that give out this money are, corrupt or stupid or don't know what they're doing. But again, it's important to know where your yield comes from, because if you don't know where your yield comes from, you are the yield. I think I've said that one before. But yeah. So yeah, Voyager totally screwed the pooch. BlockFi, on the other hand, really interesting situation there. So they also had a loan with Three Arrows Capital. They're down 80 million or something. What happened here is FTX stepped in, the Fed of the crypto community, I guess, and they said, we're going to give you a $400 million line of revolving credit to make sure that your customers are whole, they don't lose faith in your system. And also, we're going to float an acquisition price of $240 million, potentially up to $240 million. Could be a lot less than that. But that's coming off the heat of this company was valued at $5 billion not too long ago. There was a rumor, I think, at some point yesterday that they were going to sell BlockFi for $25 million because essentially, like, everything on their books is just like bad loans. But I don't think that's true. But I mean, even at a maximum of $240 million, you're talking about shareholders likely taking a drawdown of at least 80 to 90% on their investment. But, you know, all in the name of making sure that the clients are whole. So that's good. The creditors and the clients in the system are going to be able to withdraw, it seems, no matter what happens here. And it's just the shareholders that get eked out, which is hopefully the way things should be in the future. But unfortunately, when lots of companies go belly up, it's the shareholders who get paid first, and then the customers get scraps and the employees get scraps. What else is here? So yeah, Voyager. Yeah, there's a great thread here. I'll put some links down below after the show where you can kind of dive into this stuff if you like. So FTX also passed on a deal to buy Celsius, and again, I don't know why I'm smiling on this, but it's just kind of interesting. Celsius, I think, was looking for someone to bail them out as well. FTX passed on it. And I don't know where the thread is, but one of the rumors I was reading is that the way that Celsius was doing their accounting was really weird, and they actually ended up losing money during the bull market, which is part of the reason they were pushing their Cell token so hard and always trying to do fundraising rounds. And they got one of Canada's biggest pension funds to invest in them, which is just mind-blowing. No research done there. So one of the issues is, let's say you deposit like 1 Ethereum into Celsius, and they're paying you, there's theoretically like 10% yield per year. They would owe you 0.1 ETH at the end of each year. What they were doing is they were just telling people the interest they were accumulating on paper and not actually providing or having that asset on hand in the case that somebody would want to actually withdraw the cryptocurrency off the platform. So let's say you'd had 1 ETH in Celsius for a year. By the end of the year, you have 1.1 ETH. That 0.1 ETH of interest didn't actually exist on their balance sheet, right? They were just keeping cash. And so if you decided to withdraw, they'd have to go out and buy that 0.1 ETH. And if the price of ETH was way higher than what the average price was over your interest period, they would actually lose money on giving you interest, potentially a lot, because the price of ETH, I think, went from like 1,000 to 4,000 that year. So yeah, a bunch of nonsense. But just to wrap the show all up here, let's talk about some positive news. I think this Contagion thing with the crypto space is still going to ripple on for a bit, but it seems that the big players like FTX and Binance are coming to the rescue for some of the firms that have somewhat decent loans and user bases. Again, all I will say is that unless your money is in FTX and Binance and, you know, ShakePay and Coinbase and these like top tier, number 1 tier exchanges, you are putting yourself in a ton of risk. So pull it off. Put it onto a ledger or put it onto one of these major exchanges. Even these decentralized exchanges too, I think, can be a little bit risky. Although I think you hold the keys, so maybe it's a bit different. But anyways, there's no point in risking it anymore. Forget about yield for a year, okay? I know that the price of crypto's gone down and it sucks for a lot of people, but chill out on the yield hunting for a year. I do have a partnership coming up with Ledin. I believe that they are one of the only ones in the space that actually is and has been fully accountable. But, you know, it's to your own discretion, right? Make sure that the companies that you're investing with have proof of reserves. You know how they're generating their yield, where they're lending it out to. Companies like Voyager, companies like Celsius, none of this stuff was transparent. None of this stuff was open. Same with BlockFi, right? BlockFi was doing a GBTC arbitrage, right? So if you're going to get yield, get the full picture. And I think eventually I'll put out a video that will help people kind of vet the places where they're lending out their crypto a little bit better. I did put a video out on crypto scams. You can check that one out. That was on one of my YouTube stories. But yeah, just be cautious out there. That's all I'll say. Okay, positive news, because good stuff has happened in the crypto space. A study came out from MasterCard that showed that half of Latin Americans have used cryptocurrencies. MasterCard survey shows. So I think in contrast, it's something like 15% of Americans have and like 8% of Canadians have, or 13% of Canadians have. So like I've been saying, cryptocurrency adoption makes so much sense in countries with, insane inflation. And you can see this in the data too, that like people in Argentina have a much more positive view on crypto in Nigeria than they do in the US or China. It's just the nature of money itself, right? They need alternatives, right? And it's either they're going to trust the US dollar, which they might not even have access to, or they're going to trust cryptocurrencies. And so a lot of people have made at least one transaction here in cryptocurrencies in all of Latin America, which is really impressive. And that number obviously is only going to go up, but we are the ones who are behind now in terms of crypto adoption. Despite everyone owning a lot in US and Canada, percentage-wise of the population, we are behind in understanding and actually using the technology. This is interesting. This is a time lapse of the Nautilus crypto mine. It's one of the first nuclear-powered crypto mines that's going to develop up to 300 MW of zero-carbon Bitcoin mining capacity. So I think that's a first, because we've heard hydro dams and all these places mine Bitcoin, but nuclear is interesting. Big proponent of nuclear. It's a lot safer than people would have you believe. And again, zero carbon. There are now mining pools, actually. I think one called Terra Pool, terrible name, Terra Pool, where everyone in the pool has to kind of pass an inspection as to, how they're mining crypto. And so you're finding mining pools now that are, I guess you could say, mining like ESG friendly Bitcoin, but it doesn't matter. All Bitcoins are Bitcoins. But now you can see, look, if the Bitcoin came from Terra Pool, it's green and it's clean, and that's kind of cool to see. And I obviously think that most crypto mining is going to move away from fossil fuels altogether. Wow, my voice is starting to go. I don't have the articles here, but just two little other notes that I wrote down just from things that I passed. A lot of people are worried about Tether in this whole situation with the crypto contagion. To clear some stuff up with Tether, they actually just announced that they are getting rid of commercial paper. So Tether has $60 billion of US dollars. A good 50% of it is in US treasuries, like 10% of it is cash on hand for people who want to actually redeem it. And then the other chunk is in things like commercial paper or other investments. They are starting to really move the treasury almost fully into US bonds, and that's likely because the rates are higher now, and it makes sense. The business model for Tether is they have one-for-one backed USD, but if all that USD just sits in a bank nowhere, there's no model, and they got to make money out of it somehow. And so what they're doing is they take the US dollars that are sent to them and made into tethers, and they take those US dollars and they invest them in treasury bonds, which again are pretty risk-free. So you can rest assured knowing that Tether is actually increasingly becoming safer and safer. Despite the crypto market downturn, they are taking steps to make sure that they can keep their business model going while not putting any solvency risk on the table. And again, a lot of people are like, well, how do you know that this stuff's backed? Well, you can go on to treasury sites and see the owners of these treasuries, and you can see Tether Limited actually owns a whole bunch of these US treasuries. And again, they're all short-term bonds, right? So they're 120-day maturities and stuff like that. So at a moment's notice, if some big person has $20 billion of Tether and they want to redeem it, they can take it to Tether. Tether will give them the US dollars back, because all they have to do is just get these treasuries rolled over into cash again. So I think they're pretty safe. Also, 2013, they've survived a couple bear markets. I don't think this one's any news to them at this point. So yeah, I'm not really worried about holding money in Tether. That's just me personally, but it is what it is. And then Nayib Bukele, president of El Salvador, bought 80 more Bitcoin, which is cool. He still has faith in it. Dollar cost average. It's the way to do it. I'm making a little short video on this too, but someone posed this interesting thought that perhaps El Salvador's whole foray into Bitcoin isn't really costing them anything, because it's brought them so much more international spotlight and this massive increase in tourism. So, the money on paper they may have lost from buying Bitcoin is actually being offset by all the tourism gains and the GDP growth that they're going through. last year they had the largest growth in GDP that they've ever had as a country. And I know that's rebounding off of, a big decline because of COVID, but tourism is increasing rapidly there. I highly recommend taking a trip down there. It was a blast. People are amazing. But people are finding El Salvador, and they're finding it likely because of the whole Bitcoin thing. And they're also doing a lot to attract more entrepreneurs to live down there. So positive news. Bitcoin keeps chugging along. New block every 10 minutes. None of this contagion stuff actually affects the fundamentals. It only affects centralized companies that don't understand counterparty risk. And unfortunately, the users that belong to those companies. But now is the best time to go out and learn how to set up your own node, learn how to set up your own wallet, and become self-sovereign with your Bitcoin, as opposed to leaving it in the hands of other people who just write you IOU letters. And with that, we will wrap up the show here. All right. Let's pop out the chat here real quick. If you guys have any questions about today's show, ooh, no, that doesn't look good. Let me know, and we can talk. I'm trying to think if there's anything I didn't cover today. I kind of hopefully ripped through it a little bit for you guys. Also, give this video a like if you're still watching. I really appreciate it. It helps the algorithm cycle it to more people. You guys really came in clutch on the last one. That was the most viewed stream we've ever had, which was the Will the Crypto Market Pop. I think that has something to do with the thumbnail, but who knows. Celebrities in 10 years will be electricians, plumbers, and engineers. Well, we'll see. It depends what they invested in. Every single one of these economic cycles, you kind of see these like faint stories of celebrity bankruptcies. So that'll be interesting to see who has been overinvested in certain things. I know that like a lot of these influencers in the crypto space, like Jake Paul and Kim Kardashian and all these people, I'm sure that they have lots of cash on hand, but I'm also sure that they've invested in some of these like shitty schemes, and they're probably down big, and who knows, right? The actors that and the celebrities that have bad coke habits are going to be hit the worst. And by coke, I definitely mean Coca-Cola, because it rots your teeth and everything else. Dustin158. Is this Dustin from the Vancouver Bitcoiners thing? Not sure. But thanks for watching. I appreciate it. I hope you got something out of this. Yeah, we're going to do one next week. We got a sponsor coming on the show, Ledin. I'll tell you guys about them. But yeah, you're going to keep grinding it out. Listen, I'll give you guys like a life update. I don't know if you guys care about like what's going on in my life, but like many of you, I also own a lot of Bitcoin and speculative assets, tech stocks, whatnot. I've seen my net worth like destroyed, right? Like it's down so big from all-time high, but I've kind of cleansed my mind of that a little bit. The other thing is, the way that I make income is usually through trading, or it's through my business. I don't make any money on these YouTube shows. Until next week, I'll start making like a little bit, but this is just to cover like the hosting costs, essentially. I don't really pocket any of it. But I really enjoy this, right? And I'm going to be able to like survive all this stuff. I'm worried about people who, don't have other sources of income. And the problem with, the economy going into recession is people, they want to watch media that I guess reaffirms their fearfulness rather than their optimism. And so in a bull market, it's the opposite. People are looking for opportunities. And so all the news media and all the videos that come out are all about, here's how to 10x your money, right? And it's like, if you look at Andre Zick or Graham Stephan or any of these like other finance YouTubers, the last, couple weeks or months of their content has all been like, market crash, is the market going to zero? It's like people like Michael Burry become hit celebrities overnight, right? Because people are momentum driven, and they're in the moment, and so they're going to look and they're going to reaffirm stuff with negative news. And that's not to say that I haven't been talking about how crappy the economy might be in the next few months on this show, but there's always hope around the corner, and Bitcoin is that hope, I think. And it's going through this like really painful time where the price of the asset denominated in US dollars is getting crushed, right? Because it's the first to go. It's magic internet money to most people still, right? It's this totally speculative thing. People will cling on to the real things in their life, right? First, the things that they understand. Those will be the last things that people sell, like their houses, right? But despite all this, you have to realize that Bitcoin has come out of situations like this before. Now, some people have said that Bitcoin has never, made it through a recession, but Bitcoin was invented because of the recession, because of all the central banking and the money printing that happened in 2008. This was the original use case for Satoshi, and the reason that he decided to create this. I like to think in an alternate reality, if central banks knew what they were doing, we probably would never have a system like Bitcoin, because there wouldn't be a demand for it, right? If we could trust central banks to have steady money, it would just play its course, and then in an alternate reality, we would have central bank digital currencies. They just make like an easy way to send money back and forth. That's all in a centralized ledger, and they're going to do that eventually, but they would do that and there would be no Bitcoin. But because central banks are fallible and they make mistakes and they admit that they don't know what they're doing with inflation, we have things like Bitcoin. And people look at the price as the indicator of whether or not Bitcoin's alive or not. But every cycle we get more and more people that understand it's not about the price. It's about the adoption and the technological network and how you can settle value on this network with no counterparty risk. And in a world where we are increasingly going into risk, having an asset that can maintain itself, that is fully automated, that doesn't rely on miners or nodes to be there 24/7, that can adapt to things automatically on its own, it's going to become valuable to people. And it might take another surge in price for everyone to really finally understand it. But these are the times where you get out there, and I'm hoping to make a lot more content to just explain what Bitcoin is and how outside of the price factors it is really useful, and it serves a really useful function in a society and an economy that we have in Canada, US, and the rest of the world that will always be doomed to failure, because humans just cannot be trusted and they cannot maintain these monetary systems forever. And the amount of time that they sustain them for gets shorter and shorter in duration each time. Empires last for 200, 300 years previously. We've been on this fiat experiment for 50, and look how much wealth inequality we have. And look at how many things are breaking, and look how many bailouts are needed, right? So everything compresses until we have a big paradigm shift. And I think we're going to get that paradigm shift in our lifetimes. And, Bitcoin does its thing every 4 years. We get closer and closer and closer and closer. And that's all that matters. So yeah, rant over. Definitely tough times. Do my best to stay positive. Hopefully we all laugh about this in 5 years. Yep. Zoom out to the 4-year chart. It's the best performing asset in history. Yeah, it is. But again, like 4 years is so long for a lot of people, right? And to sit through this volatility can be brutal. So what I say is like, and I say this in contrary, like some people say never hold any cash, right? Cash is trash. Like, well, cash is going to lose value at 2 to 10% a year, but it's always important to have some, because the market can also provide you with negative 70% years and negative 80% years, right? And so just because your cash is losing value on 1 year does not mean that it's completely useless. I think it's just good to always have a little bit and make sure you're taken care of. The worst way to invest is to go all in and be emotionally 100% tied to the price of whatever you own. If you have cash, if you're able to live without your investment going to a certain amount, then you're fine and you can withstand this volatility, I guess. So yeah, that's all I have to say. Keep some cash around. I keep some cash around. I'm always dollar cost averaging no matter what the price is, because Michael Saylor has an analogy, which is like owning Bitcoin is like owning land in Manhattan, and it's land that you can buy $5 a day worth of. But eventually it runs out and it becomes very, very scarce and persistently desirable. Manhattan will never not be a place that is desirable. The price might go up and down, but it will always be increasingly more desirable over the long term. So unless there's like a big hurricane or something, but who knows? I don't know. I always like to sabotage my analogies, but whatever. Anyways, guys, thanks for watching. Enjoy Canada Day. Thanks for tuning in if you're from Canada. And enjoy July 4th, America Day. Is that what you guys call it down there? Enjoy that as well on Monday. And I'll see you guys next Friday. And of course, every Monday and Thursday for the stories. And who knows, maybe some other surprise videos along the way too. Thanks so much, guys. Take care, and I'll catch you in the next one.